Warren Buffett's investment journey began at the tender age of 11, where curiosity intertwined with ambition. Young Warren dove into the bustling world of stocks, experimenting with various techniques. He meticulously studied stock timing and charting trends, captivated by the dynamic dance of numbers on a screen. The thrill of the chase was exhilarating, yet as his small investments progressed, he soon recognized that these methods proved to be profitless but fun. While the charts dazzled with visual appeal, they lacked the vital substance of actual business fundamentals, a lesson waiting patiently in his future. In the shadows of his formative years, Buffett's hunger for knowledge propelled him through the aisles of his local library. Like a determined explorer on a quest, he devoured every investing book available to him. This relentless pursuit of wisdom reflected his genuine passion for the art of finance. Yet, despite his voracious reading, he felt an emptiness, a lack of direction. It was as if he was lost in a maze, scouring for a map that would guide him through the complexities of investing. The foundational principles of investing still eluded him, shrouded in mystery until he stumbled upon Benjamin Graham's The Intelligent Investor. Graham's teachings acted as a lantern, illuminating the path ahead. Buffett discovered that investing was not merely about chasing stock prices, but understanding the intrinsic value of companies. Graham's emphasis on analyzing a business's fundamentals planted the seeds of Buffett's investment philosophy. He transitioned from a novice fascinated by fleeting trends to a sage, equipped with a framework to assess value. This pivotal moment marked a transformation, redefining Warren's approach to investing. Equipped with Graham's wisdom, he began to cultivate a mindset characterized by patience, discipline, and a focus on long-term growth rather than short-term speculation. His early experiences laid a sturdy foundation, creating a legacy that would resonate within the investing world for decades. By embracing the lifelong lessons from Graham, Buffett embarked on a journey that would eventually lead him to become one of history's most successful investors. His initial misadventures in the stock market acted as essential stepping stones, pushing him to seek deeper understanding beyond surface-level excitement. Ultimately, Buffett's early investing years illustrate the importance of knowledge, mentorship, and the trial-and-error process in forming a robust investment philosophy. This dynamic blend of curiosity and learning crafted a roadmap not only for Buffett, but for aspiring investors everywhere, encapsulating the essence of making informed decisions based on the fundamentals rather than the fleeting thrill of market trends. Investing is about thinking like a business owner, recognizing that stocks represent ownership in real enterprises. When you purchase shares, you are not merely acquiring a few numbers in a trading platform. You are obtaining a portion of a functioning company with its own economic characteristics. Focus on understanding how that business operates in the market. Look for competitive advantages or moats that protect it from rivals. Is there a unique product, a trusted brand, or a significant market share? Moreover, assess the quality of management. Strong leadership can make or break a company, guiding it through challenges and positioning it for growth. Now, picture Mr. Market, your emotional and oftentimes erratic partner, offering prices that often fluctuate wildly from day to day. Imagine him as a manic depressive character who presents you with a daily valuation of your investments. Do not be swayed by his mood swings. His manic highs and depressive lows can cloud your judgment. Instead, consider how to ignore these emotional fluctuations. Seize opportunities when Mr. Market's offered prices are irrationally low or absurdly high. Think of it as navigating a landscape where fields of investment can be cultivated without swaying with every gust of wind produced by market sentiment. Lastly, consider the principle of margin of safety, which is like a sturdy bridge designed to carry hefty loads safely. When investing, always seek to buy at a considerable discount to a stock's intrinsic value. Just as you wouldn't risk crossing a bridge rated for 10,000 LEBs with a truck weighing nearly its capacity, avoid pushing your investments close to their limits. Instead, patiently wait for those opportunities that seem to shout for attention, the ones that present low-risk entries into fundamentally sound businesses. By embracing these foundational principles through the lens of Graham's teachings, investors can navigate the unpredictable stock market more wisely and maximally enhance their financial well-being. In the pursuit of sound investments, understanding how to apply these principles is crucial. The first step involves identifying businesses that possess a robust competitive advantage, often referred to as a moat. And this can manifest in various forms, such as Coca-Cola's iconic brand presence, unique patents that shield innovation, or geographic dominance. These assets create barriers that protect companies from the harsh winds of competition, ensuring a sustainable profit stream. Conversely, it is essential to steer clear of industries where competition can erode profits swiftly, such as restaurants or commodity products, where differentiation is minimal and consumer loyalty can be fleeting. The second step centers on the quality of management. Look for businesses led by individuals who not only showcase honesty and integrity, but also possess the capability to maintain and grow the company's success. The guiding principle is simple. Seek out businesses that are so fundamentally strong that even a novice could run them effectively. This holds true in real-world scenarios, as sometimes unexpected changes in leadership can occur. Warren Buffett himself humorously notes this resilience when he declares that Berkshire Hathaway is so solid it could thrive even if he were to falter in his leadership, illustrating the importance of having a capable management team in place. Finally, price must not be overlooked. When evaluating a business, it is imperative to value it first, methodically, and without the influence of its current stock price. Ignoring the price initially allows for a clearer, more objective assessment of the company's fundamental value. Much like handicapping horses at a racetrack, it's vital to analyze their performance metrics before being swayed by the odds presented. This disciplined approach fosters a reasoned investment strategy and ultimately guards against impulsive, emotional decision-making. By following these structured steps, identifying moats, assessing management integrity and capacity, and valuing businesses independently of their stock prices, a more calculated and advantageous investment portfolio may be achieved, yielding fruitful results over time. Investing can often seem overwhelming, but with practical advice, you can navigate the complexities of financial markets. One of the most effective strategies is to screen aggressively. This means quickly eliminating the vast majority of investment ideas that don't meet specific criteria. For instance, certain sectors like car dealerships or airlines typically offer less potential for significant returns and should be crossed off your list in the early stages. By rapidly filtering out unpromising avenues, you can concentrate on more lucrative opportunities that are worth your time and money. In the world of investing, thinking long-term is crucial. Successful investors understand that you only need a handful of great ideas across your lifetime to build substantial wealth. Think of investing akin to a punch card analogy. If you had just 20 opportunities to make impactful investments, the pressure would compel you to choose wisely. This mindset encourages diligent research and patience. Instead of pursuing every fleeting trend, you'll be motivated to identify and cultivate high-potential investments that can yield rich rewards over many years. Another vital aspect of investing is focusing on big opportunities. Small bets might seem tempting, but they rarely lead to meaningful change in your financial situation. It's essential to wait for high-conviction ideas, those that resonate with your analysis and intuition. When you identify a significant opportunity, it's like finding a rare gem in a sea of options. By concentrating your resources on a few well-researched prospects, you stand a higher chance of securing substantial returns. Learning to manage risk while maximizing potential rewards should be at the forefront of your investment philosophy. Stick to your principles, remain patient, and remember that the path to wealth is often paved with strategic, well-timed decisions rather than impulsive actions. Investing is often seen as a serious endeavor, but Warren Buffett brings a refreshing blend of humor and wisdom to the world of finance. His perspectives challenge the conventional notions and provoke thought, often wrapped in a humorous package that makes them even more memorable. One of his wittiest observations is about charts. He quips, "Sometimes you turn the chart upside down, it still wouldn't help." This poignant statement highlights the limitations of relying solely on visual data, reminding investors that numbers can't capture the essence of a business's potential or the real market dynamics at play. Buffett's characterization of the market is equally thought-provoking. He refers to Mr. Market as an alcoholic manic depressive, which beautifully encapsulates the volatile nature of the stock market. This colorful analogy not only injects humor, but also serves as a pivotal lesson in emotional detachment. Investors are encouraged to remember that the market behaves irrationally at times, and just because it is in a frenzy doesn't mean you have to follow suit. Instead, he suggests a more rational, fact-based approach to investing, where one does not have a moral obligation to react impulsively to market whims. One of his core tenets revolves around the concept of diversification. Buffett asserts, "If you're right about the business, you don't need to own many stocks." This statement challenges the common belief that more holdings reduce risk. By focusing on a select few businesses that you understand well and believe in, you can achieve greater returns than spreading investments thinly across numerous stocks. It advocates for thoughtful investing, highlighting the importance of quality over quantity. In essence, it encourages investors to do their homework and build a portfolio based on strong convictions rather than attempting to play it safe by diversifying into mediocrity. In a world bustling with confusion and emotional turmoil concerning investments, Buffett's humor and wisdom provide clarity. His observations are not just entertaining, but are also deeply instructive. They show us that having a lighthearted approach can coexist with serious financial strategies. Through Buffett's lens, the world of investing appears not just as a battleground for capital, but as a space to engage thoughtfully, practically, and yes, with a good dose of humor. After all, the best investors are those who enjoy the journey as much as the destination. Buffett's investment philosophy is often encapsulated by three fundamental qualities: patience, discipline, and a business owner mindset. These characteristics create a robust foundation for successful investing, helping an investor navigate the unpredictable waters of the financial markets. The journey starts with patience, as market fluctuations can cloud judgment, leading many to chase fleeting short-term prices. Instead, patience requires a long-term perspective, focusing on the potential growth of durable investments rather than the whims of market trends. Discipline serves as the guiding principle that refines and polishes investment strategies. It enables investors to adhere to pre-established plans and principles, preventing emotional decision-making during market highs and lows. Many fail in investing because they overreact. Discipline fosters a steady hand, encouraging one to stick to the fundamentals. This disciplined approach is particularly vital when multiple external factors vie for attention, creating noise and distractions that can derail a rational investment strategy. The concept of a business owner mindset transforms the way investors engage with their investments. Viewing stocks not merely as pieces of paper but as ownership stakes in vital businesses fosters a deeper understanding of what drives value. A critical component of this mindset is recognizing economic moats, the competitive advantages that protect a company from its rivals. Identifying these moats requires keen observation and analysis, yet many overlook this fundamental aspect. By paying attention to sustainable advantages, such as strong brand loyalty or unique intellectual property, an investor can separate lucrative opportunities from passing fads. In the realm of investing, simplicity is often lost amidst complexity. Many investors tend to overcomplicate their approaches by layering strategies, using convoluted metrics, or relying too heavily on market forecasts. However, the essence of effective investing is grounded in the timeless wisdom presented in Benjamin Graham's The Intelligent Investor. This classic treatise emphasizes core principles that remain relevant despite changing market conditions. Graham's metaphor of the three-legged stool highlights the necessity of a balanced approach. Without one key principle, the entire investment strategy risks collapsing under volatility. Ultimately, Buffett's success is a testament to the power of adhering to foundational investment principles. By cultivating patience, exercising discipline, and maintaining a business owner perspective, investors can navigate the turbulent waters of the market more effectively. As the timeless advice from Graham illustrates, mastering these concepts can lead to a more profound understanding of investing, promoting long-term success and financial independence.